Holy smokes, this is actually worse than I thought. My brother and I yesterday reacted to a video made by Graham Stephan and his commentary on what could be the next mortgage crisis. And I started adding different facts and doing some research. This is actually a lot worse than I thought. Hey, what's going on everyone? This is Kwak here, one of the Kwak brothers, and I want to share something with you guys that could turn into the next mortgage crisis, which could mean a wave of foreclosures, short sales, and loan modification. This could be 2008 version 2.0. Now, before we get into the video, be sure to subscribe to our channel if you want more updates and information on what could be the next mortgage crisis and investing in real estate. So first, what is this mortgage crisis that could potentially blow up on the economy in the next 3 to 5 months? Well, it has a lot to do with the current situation right now, with the fact that a lot of people are losing their jobs right now because of the coronavirus, and a lot of people are requesting for mortgage forbearance or mortgage deferment. Even the recently passed CARES Act has a provision for mortgage forbearance on federally backed mortgage programs. So what is this mortgage forbearance? Well, a mortgage forbearance is simply your lender, your bank, simply letting you off the hook of not having to make a mortgage payment on a given period of time. If you have a mortgage that's backed by the federal government, according to the CARES Act, you can request up to 180 days of mortgage forbearance by default and request an additional 180 days, totaling 360 days of mortgage forbearance. So basically, within 360 days, you don't have to make a mortgage payment as part of the CARES Act stimulus to help people with the situation right now. Even the banks that are offering mortgages that are not backed by the federal government, they're also offering forbearance and deferment options. Now, at the bank level, it does create a concern for the mortgage-backed security industry as well as the loan servicing company, but that's a conversation for a whole nother video. Now, if you want to learn how that issue can blow over, be sure to smash the like button, turn that like button to blue. Now, here's something that the banks may not be telling you about the mortgage forbearance programs and options. When a bank gives you the option of a mortgage forbearance, they may request a lump sum payment at the end of the forbearance period of all the payments that you have received. So if you received a 3 months worth of mortgage forbearance, the banks may request a lump sum payment of 3 months of mortgage payment in addition to the next month's mortgage payment, totaling 4 mortgage payments in a single payment. Now, obviously, this creates a major issue considering the fact that a lot of people are unemployed right now. They're draining through their savings just to stay alive. But with the fact that the banks are offering forbearance options and a request to make all lump sum payment at the end of the forbearance period, I think that's a recipe for a disaster. You see, if you don't make that lump sum payment demanded by the banks could potentially foreclose on your property or ask that you sell the property on a short sale or give you additional mortgage forbearance, which ultimately is just delaying the problem itself. And even if you could make that lump sum payment at the end of the forbearance period, taking a mortgage forbearance could have a future impact on your ability to get new financing. So if you want to buy a new property, you want to get a refinance, having a mortgage forbearance could have a negative impact on your ability to get new financing. Especially if you're a real estate investor or you frequently flip houses, this could cause an issue if you're trying to get new financing to get into a new investment project. Now, not all banks are demanding a lump sum payment at the end of the forbearance period. This is where you need to understand and get clarity on what it means to take a mortgage forbearance. When you go get a mortgage forbearance, make sure you get it on writing and be clear about what it means to take on a mortgage forbearance. Instead of a lump sum payment, the banks may just simply take the missing payments and put it on the back end of your mortgage, meaning by the time you reach your 30-year mark or 15-year mark, you just simply catch up those payments later down the road. Or the banks may give you a separate loan just on the missing payments and have you make those payments within 24 months or more. So when considering taking a mortgage forbearance, know your options and understand exactly what you're getting into. Have your lenders or banker put it on writing, exactly how the missing payments will be treated. Will it have to be paid back in a lump sum fashion at the end of the forbearance period? Or will it be just tacked on the back end of the mortgage? But I do believe within 3 to 5 months, there are going to be individuals that didn't quite understand what that meant, and they're going to run into a situation where they have to do a lump sum payment and they can't because they don't have the money to do so, and this could cause a wave of foreclosure foreclosure as well as short sales that may come about in 3 to 5 months. So what do you guys think of all of this? Will this create a new wave of foreclosures and short sales? Will this be an actual crisis? Tell me what you guys think. Leave your comments down below. We'll love to have a conversation with you guys. But ultimately, I want to share something that you should have done to not have fallen into this trap and not having to get a mortgage forbearance in the first place. For many of you guys that have subscribed to our channel or been watching our channel for a long time, you guys are aware of our HELOC strategy. Now, for those who don't know what a HELOC is, it's an acronym for Home Equity Line of Credit. A HELOC works just like your credit card, but it's attached to the equity of your home. A lot of times, HELOCs are given out as a second lien position HELOC, which means that you have an existing primary mortgage, and on top of that, you get a second lien HELOC. And a lot of times, people get a HELOC to do home improvements, to do some repairs on their property, or they can use it to pay off their mortgage, which is something that we teach quite a bit here in our YouTube channel. But there's also a little less known version of the HELOC, which is the first lien position HELOC, which essentially is the only debt that you would have on your property. So instead of a second lien position where you have a primary mortgage and a second lien HELOC, you essentially have just a HELOC. And it works just like a mortgage, except you have the ability to tap into the equity and draw the money out whenever you need it very quickly. So here's where the first lien position HELOC would have solved this issue and not have to take a mortgage forbearance. Instead of requesting a mortgage forbearance with a HELOC, you could do what's called floating the debt. Remember, with a HELOC, you can tap into your equity and take the money out whenever you need it. So what you're essentially doing is you're taking enough cash out of your HELOC to make the payment on the HELOC itself. So you're essentially recycling the funds to satisfy the monthly minimum payment on the HELOC. Now, obviously, this is more of a temporary measure to keep you afloat until you can bounce back and recover back into the normal life. You can also use the HELOC to cover any expenses in case you've lost your job or your income goes down temporarily until you can go and get a new job or you're hired back as soon as this whole virus pandemic is over. This way, you don't have to request a mortgage forbearance, and with the HELOC, there are no penalties of floating the debt as long as you make the minimum payment each month. And you don't have to deal with the fact that the banks may ask for a lump sum payment at the end of the forbearance period. Getting a mortgage forbearance, again, could have an impact on your future ability to get new financing. You can also use a HELOC to pay down your mortgage even faster, and I've seen a lot of people use their HELOC to pay off their 30-year mortgage within about 5 to 7 years on average. So if you want to learn that tactic, I'm going to go and leave a separate video down below where you can learn how to pay off your mortgage faster using a home equity line of credit. So some of you guys that were skeptical about this HELOC method, now you might be saying,
oh my gosh, this random Asian guy on YouTube is right. We should have gotten a HELOC. What were we thinking?
Now, another way that you could have avoided this whole mortgage forbearance scenario is owner financing. Now, owner financing is an acquisition strategy whereby a buyer and a seller create an arrangement to where the buyer makes monthly payments to the seller in exchange for the ownership right of the property. So essentially, the seller becomes the bank, and a lot of times these arrangements will come in a form of a contract. Just like a mortgage, the buyer pays the seller principal and interest payment for a set amount of time, and each payment to the seller gives the buyer some equity, and the seller could essentially collect the interest, but not only that, could benefit from having their capital gains taxes be deferred through selling the property on owner financing. And with owner financing, you can typically negotiate with the seller and owners in times like these where you won't be able to make your monthly payment and simply ask the owner and seller for a deferment or a nicer version of the forbearance. Unlike the banks that are asking you for a lump sum payment or some sort, you can oftentimes negotiate some creative solutions with other individuals versus having to negotiate something like that with the banks. And a few other benefits of buying properties using owner financing is that the payment activity to the seller doesn't report to your credit report, and it doesn't affect your debt to income ratio. So when you need to go and get actual bank financing, your owner financing arrangement with your seller won't necessarily impact your ability to get financing with an institutional lender like a bank. So if you're interested in learning more about owner financing, my brother and I have created dozens of videos about owner financing here in our channel, so be sure to subscribe if you want more videos and information about owner financing. So all in all, with the situation of unemployment and people requesting a mortgage forbearance, I do see a potential for a major mortgage crisis down the road, which can blow up on the economy, and we may see a wave of foreclosures and short sales and all sorts of mess that we don't want to necessarily see. So if you guys want to continue getting updates as well as new information about what it means to get a mortgage forbearance, be sure to subscribe to our channel and also check out some of the other resources I have down below in the link description. Is there a recession coming up? And if so, how do we protect our home by paying off our mortgage faster? In 2008 to 2012, in our last Great Recession, people lost their homes due to two main reasons.
Costs including appraisal fees, transaction fees, processing fees, smashing the like button if you haven't done that already fees, title.
All right, so a couple of things. Now, when you get a mortgage, when you go refinance, which Graham will suggest later down the road, you're gonna pay appraisal fee too. So it's not like with a HELOC, it's exclusive where you have to pay an appraisal fee. You're gonna pay an appraisal fee no matter what if you get a HELOC or mortgage. So throwing this ticket.